This video is a debrief of task 2 from the second sample assessment of applied management accounting. This task is about budget preparation, evaluation and revision. So in task 2 we're provided with some information. Oakfair Limited is preparing its resource budgets for the next period and has the following data. So we're told that we have some opening inventory of finished goods. Now notice this is finished goods because we're going to have to think about inventory for our materials in a moment. So we've got our opening inventory, we've got our production, so we make some more of the inventory, we then sell some of it, so our sales reduce how much inventory we have, so that's that negative number, and then that leaves us with our closing inventory of our finished goods. We're also provided some notes about materials. So for each unit we produce, we need 0.6 of a kilogram of materials, and also our closing inventory will be valued at the budgeted purchase price per kilogram. And then for labour, each item takes 5 minutes to produce. We have 82 staff who each work 120 basic hours. And then on top of that, if there's any overtime, this is paid at 50% above the basic hourly rate. And they're also told in terms of production overheads, our variable overhead is based on total labour hours. So we're asked to complete the two schedules using the information that we have in the production budget and notes above. And it's telling us to put all numbers as positive values. So first of all, we're going to look at our materials, and we're given some data here. So we've got our opening inventory, and we see we have 4,400 kilograms with a cost, and we've also got our closing inventory as well, which is 3,700 kilograms, and we have a cost there as well. Now we need to recognize that for our inventory, it has different values. So if we take our cost per unit for our opening inventory, so we'll have the cost of 5280 and divide by the number of kilograms. So that gives us a cost of 1.2 per kilogram. And if we do the same for our closing inventory, we have a cost of 4625 divided by the 3,700 kilograms, and that gives us a cost of £1.25 per kilogram. Now the question doesn't ask us to calculate that, but we do need to recognise that the opening inventory is cheaper per kilogram than the closing inventory, and we're going to have some significance a little bit later on when we're doing the further calculations. So what we need to do then is we know the opening and closing inventory, so we need to work out how many purchases we made, and notice that the purchases were at 125, and we've confirmed that that's the case. It tells us, doesn't it, that closing inventory is valued at the budgeted purchase price. So yeah, that's correct. And we also need to include how much of the kilograms was used in the production process. So if we look at the data we've been provided, it doesn't tell us how many kilograms we purchased. Okay, none of that information is available, but we are told about how much production there was. We know that we made 174,000 units. Now that's not kilograms though, is it? That's units, but we do know that we use 0.6 of a kilogram for each unit that we make. So if we take our 174,000 and multiply by 0.6 of a kilogram, that gives us 104,400 kilograms. Okay, so that's the figure that we need to include in our answer. So now that we know how much we use in our production and we know how much is in closing inventory, that can tell us how many purchases we made. We started the year with 4,400 kilograms and purchased some more, and then that would give us a total of available kilograms, from which we used the 104,000 in production, and then we're left over with 3,700. So what that is telling us is that the total of our opening inventory plus our purchases must be the same as how much we used and how much inventory was left over. So if we add together the 104,400 and the 3,700, and then we deduct from that the 4,400 that was in the opening inventory, that tells us that we must have purchased 103,700 kilograms during the year. Now we're told that each of these was purchased at £1.25, so we can multiply that by the £1.25, and that gives us our cost of 129,625. So the missing number that we have relates to the cost of what was used in production. And the complication we have here is that, well, what have we used in production? We need to recognize that some of our production would be taken from our opening inventory, which cost £1.20 per kilogram, and some of our production would have been purchased in the current period, and that cost £1.25 per kilogram. So there are a couple ways that you can work out the cost of our production, but let's use the same way as we did with the number of kilograms. We know that our opening inventory plus our purchases must be the same as the cost of our production and what was left over in closing inventory. So if we add together the 5,280 plus the 129,625, and then we deduct the 4,625, that gives us an answer. The cost of our production must have been 130,280. So let's think of the alternative way of doing this. So what you could also do, we know that we produced our products and we used 104,400 kilograms to do that. Now of that would be the opening inventory of 4,400 kilograms, and therefore from our purchases we must have consumed 100,000 kilograms. And so of that total consumption, some of it was opening inventory and the rest of it was from the purchases. So we know that of the purchases, that's valued at £1.25 per kilogram, and then for the opening inventory we know that's got a total value of 5,280. So if we take the 5,280 plus the 125,000, that gives you the same figure, 130,280. So it doesn't really matter which way you want to calculate it, both of them will get you to the same result in the end. Right, let's move on now to our labour calculations. So it's asking us then to work out the cost of our labour split between the basic and the overtime. Well, we're told that we have 82 staff who work 120 basic hours. So if we multiply those together, that tells us we have a total available of 9,840 basic hours. Now what we need to understand, will we be able to satisfy our production using only those hours, or do we need more? So what we need to do then is go back to our production schedule. So we know that we're making the 174,000 units, and we need to multiply that by 5 minutes. So that gives us 870,000 minutes. And if we divide that by 60, that'll tell us how many hours we need. So we need 14,500 hours in total to satisfy our production schedule. So we can put that number into our table. So the total hours needed is 14,500. Now that's bigger than the number of hours available for our basic pay. So that means we're going to consume all of the 9,840 hours. And therefore the difference of 4,660 will be paid as overtime. So for the basic time, for the 9,840, we need to multiply that by the £9 because we pay £9 per hour, and that's going to give us a basic labour cost of 88,560. Now for our overtime, we need to multiply that again by the £9 per hour, but we're also paid with an additional 50%. So we also need to multiply by 150%. So the 4,660 multiplied by 9 and then multiplied by 1.5 gives us a cost of 62,910. And our total, well, notice that we've got a figure here, so this is going to be automatically calculated in the exam software. So yeah, we have a total of 151,470. So let's move on to part B of task 2. So Oakfair Limited is looking to complete the sales budget for the next year, and we need to identify 4 factors that could limit the total sales in the sales budget for the next year. And so what would cause sales not to just grow and grow and grow? Well, potentially we just need to look at the market conditions. So it could be that we're going through a recession and people have no money, so they're not able to buy more things from us. So yes, it could be sort of market demand will cause us to limit our sales production or sales capacity. So it could be the market demand, but there could also be some internal factors as well that stop us from making those sales. So it could be, again, we noticed that in the first part of the question that there were basic labour hours. Well, we can only work our employees so much until they're exhausted. So we might have a limited availability of labour. But not just of labour, it could be there's a limited availability of materials as well, so we can only sell so many things because we can't make any more. And there may also be the capacity of our equipment and machinery, so our plant and equipment, because we could only work our machines for 24 hours a day. And then after that, well, we just can't make any more. So there may be a limited capacity on our plant and our production facilities as well. So the question asks us for 4 factors, and we provided 4 there. Other possible answers are available as well. For part C of the task, it tells us that Oakfair Limited has now completed the sales budget, which shows a 15% volume increase in the sales for next year. So notice there's a number included in the text, and that's there for a reason. Now, you need to make sure that you use any numbers that are included in the text, because they're provided to help you earn some more marks and give you, in this case, it's going to give us a benchmark for which we can compare all the numbers provided in the table below. So it tells us that Oakfair has produced the following draft overheads budget together with budgetary assumptions used and the comparative figures for the previous year. And we're told that we need to evaluate the draft overheads budget. So remember, we're evaluating this column, taking into consideration the assumptions used in its preparation. So we are provided with the previous year's figures. Again, why are they doing that? Those numbers are there for a reason. So one of the things we can do to try and earn some marks is just look at the percentage change between the 2 years. So we can see that for the factory rent, it's gone up by 5,000, which is 10% of the previous year. So that might seem a bit odd compared with our benchmark that we expect an increase in volume of 15%. So let's just go through the other ones as well. So we can see that there's a 0% increase in the factory insurance. For administration, so we take the 48 and divide by 42, so we can see we've got a 14.3% increase. For sales and marketing, so we have 80 divided by 63, so we have an increase here of 27%. For distribution costs, we have 29 divided by 22, so we have an increase here of 31.8%. And for our head office cost, 105 divided by 102, so we have an increase of 2.9%. So notice for administration, we've got the closest to the 15% volume increase. But the other ones are not in line with our planned increase in sales. So that, again, that would suggest that perhaps our budgets aren't particularly accurate. But anyway, let's look at the assumptions as well to try and identify what other things we could talk about. Now, if you look at the marking scheme for this question, if you want to get your full marks, then you do need to talk about each line. Okay, so again, that's another important part of your exam technique. The examiners provided 6 lines in the table. You are expected to talk about each of them to be able to get your maximum marks. And the marking scheme also expected you to make at least 2 comments for each of the 6, and that will give you your 12 marks available. So be aware that perhaps if you say 12 things about rent but nothing about anything else, you're going to be capping the maximum marks that you can achieve. So let's look at the factory rent. Let's look at each of them in turn now. So remember, we've got to keep in our mind that there's a 15% expected increase in our sales volume. Now, for our factory rent, we've got a 10% increase in the cost, which doesn't marry up with the increase in our production facilities. But that's okay, because it doesn't necessarily mean that we need to expand our factory consumption in proportion to the sales increase. It really depends on the nature of the machines that we're using and how much space they take up. Potentially we could increase our production facilities without needing any space, but in this case they're suggesting that we will need some space, and it tells us in the assumptions that they're planning an additional 10% of factory space, and that's going to be rented. So remember, what we're trying to do is evaluate the budget. So do we think that assumption is reasonable? So we need to consider, is there available space for us to rent? So potentially we are using a factory in some sort of industrial park, and potentially we can just use an extension as part of the factory. But potentially that may not be so easy. If we have to rent some space that's physically in a different location, then that 10% increase may not really be appropriate. We might need some space for offices and security and so on. So where does that 10% come from? It seems to be a bit arbitrary compared with the planned increase in our production facilities. And also, they're considering a 10% increase, but what about inflation? So we would expect that rent costs would go up compared with the previous year. So if they're increasing the factory space by 10%, that accounts for the movement between these two numbers, but it doesn't include any cost increase for inflation. So overall, it would suggest that the factory rent budget of 55,000 is too small and probably needs to be a bit bigger. Now, for factory insurance, they assume that there's no increase in premium anticipated, which seems unrealistic. If we're going to be making 15% more things, then we're going to have 15% more inventory sitting around in the factory on average, and therefore the cost of insuring that inventory is going to be higher. So that 0% increase seems unrealistic given that we're going to be making more things, and also seems to ignore that there would be inflation for insurance. So again, this 8,000 seems to be understated. For administration, it tells us that half of the administration are fixed and the rest is variable. So we've got a total of 42,000 that we have from the previous year. So half of that is going to be fixed at 21,000 and half of it is going to be variable. And we're told that we're expecting a 15% increase in production and sales. So yeah, we could reasonably multiply that by 1.15 to give us our expected increase from the variable element. So that's going to be 24,150. And then the other 21,000 is going to be fixed. So that gives us a total of 45,150. And yet we've budgeted for 48,000. So it suggests that we're expecting some sort of increase in our fixed element as well. So remember, it's not fixed over time, it's fixed because it does not vary with our production. So it still may be affected by inflationary increases. So the increase is 2,850, which would give us our total of the 48,000. And that 2,850 divided by the 21,000 would give us a 13.6% increase. So that would suggest that there is some inflation included in that, plus perhaps some other administrative costs, which we would need to investigate what's included in that. But overall, there's quite a significant increase to the fixed element. Next, we have our sales and marketing, and it tells us that they're planning to have a new marketing manager of 27,000. But notice that the difference between this year and last year amounts to 17,000. So it looks as if there is a planned 10,000 reduction in their basic marketing expenditure, and there's also going to be this 27,000 increase because of their new marketing manager. So while the 27,000 for the marketing manager may seem reasonable, again they may have entered into some contract with somebody already, or that may be the going rate for that. But what we do need to think about is, well, if they're going to spend £10,000 less on marketing, how does that link with the 15% increase in their sales? So is that going to be down to their new marketing manager? It would seem a little bit odd that if they're going to spend £10,000 less on marketing, then there's going to be a 15% increase in sales volume. So there's a bit of an inconsistency there, which would suggest that their sales and marketing budget, again, looks a bit small for the current year. Then we look at our distribution costs. So we can see that there is a 31% or 32% increase in our distribution costs, which again doesn't really fit with the 15% volume increase for sales. So why is it costing them so much more to deliver their goods to their customers than last year? So potentially they have included inflation, so there may be inflation costs for fuel, and that's been quite significant recently, and that may explain it. But at the moment, those distribution costs look quite high. And then we have our head office costs, and it's telling us there that they're planning to relocate their head office. Well, that could be quite an expensive process, and it may be more expensive than the 3,000 increase that they've included there for the head office budget. So we might expect that to be a bit higher than that. So while we wouldn't expect head office costs to increase in line with the volume increase, it still doesn't seem appropriate that it's only going up by 2.9%, given that we are including that relocation. So again, for all of these, it looks as if there is the missing inflation. Inflation seems to be included perhaps for distribution costs, and administration, but it seems to be missing from some of the other categories here.